Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How's it going today? Hope you're having a great Monday here so far. This is our quick stock market update show that we do every day just to try to help, kind of go over the good, the bad, and the ugly in the stock market there, let you know how things are going, and, of course, take your questions if you have any along the way. We're financial advisors. I hope you'll check us out at jazzwealth.com. I think I have successfully covered everything. We're playing a game. It's called Guess the Dow. Bottom right-hand corner of your screen, you can go to that website. You can take a guess. What do you think? Where do you think the Dow is going to close at the end of next week? And if you're closest, without going over, we'll send you $100. If you're one of our customers, we'll credit your account. Last week, one of our customers won, actually, for the first time since we started this game. And so we credited their account $100. Should be processing today or tomorrow. Our class this week, if you don't know, every week we do a class for customers. Last week we did it live to the general public just so you could kind of see how things go here. This week, a completely different topic. It'll be private, of course, for our customers. We're going to talk about a little 401k tax advantage if you have company stock in your 401k. Help you save some dough there if you ever decide to roll over your 401k. So we'll cover that Thursday, 8 o'clock Eastern time, as we always do. All right, let's start with the markets here. Let's dive in. Early this morning, we got some notes from Treasury Secretary that said the debt ceiling deal is almost done. We'll see, right? We've heard that before. So it's kind of like, yeah, prove it to us first. Anyways, the markets were a little bit higher. We actually finished the day a little bit higher. 17 on the Dow, 8 on the S&P, and 57 on the NASDAQ. A little bit of a disconnect there. The disconnect today, by the way, was the NASDAQ. You had like Apple and Amazon and some of the stocks that are getting ready to report their earnings this week. Busy week for earnings, by the way. A lot of those stocks were a little bit higher and just positive sentiment, man. We're thinking that these guys are going to have earnings that beat estimates and that the stocks will do well. So those stocks have already kind of gotten off to sort of a quicker start there. I'll dive right in because this is really going to kind of be a short one today, I think. There's not a lot to cover today, but stick around for the rest of the week. It's going to be really, really busy. Here's the S&P 500 chopping around up here near highs. I commented on Friday that the way the markets closed, you don't like that. It doesn't bode well for higher moves. Thankfully, we have earnings. We have a positive potential catalyst to take us higher. But generally, if you see a stock do something like this candlestick pattern here, you're not going to be excited about it in the short term. If you're one of our customers, hop on over to the dojo here, which is what I'm using right now. Sort here by I believe it's Wine and Wealth. Sort by Wine and Wealth is our private video library for you guys. Scroll down a little bit here. You'll see candlesticks part 1, 2, and 3. For those of you that have no idea what I'm looking at here today, we sort of put together 3 quick classes to help explain that a little bit. I might do those classes again for our customers too and just sort of elaborate on those maybe in our Thursday class because it's really important if you can look quickly and go, all right, I don't expect the markets to blast off. Maybe earnings helps us, but if you can do that, think about what that does emotionally for you. You're no longer really going to be stressed about the ultra short term. A lot of people like to check in on their retirement investments and long-term investments on kind of an active basis. Well, if you happen to look at something like that or you follow along and you go, okay, Dustin says no fireworks here for a few days, you can sort of walk away comfortably. You know that the markets are kind of where they're at and going to, not really shoot off to the upside unless some news comes out of nowhere. And that's really helpful. So I like putting those classes together. Moving on, we'll go over to the NASDAQ here. That was the better performer of the major indices today. Same thing. What happened on Friday, not very exciting. So today, traders were a little optimistic. They just weren't willing to try to erase all of what happened. You can really feel that sort of holding back today, if you will. Low volume along the way as well. All right, earnings-wise, here we go. We got just over 15% of the S&P 500's reported earnings. That number is going to change dramatically this week. 78% beat on earnings, 67% beat on revenue. Remember, I always tell you, when people spit numbers at you, you ask, like, what does it mean? How is it relative to something? Give me some sort of benchmark, something I can go on. Well, 78% of companies that have reported so far, not a lot of them, right? It's not a big portion of the S&P, but of those, 78% beat on earnings. The average right now is 60%. It's actually 59.8, but it's 60%, right? Average beat on revenue at this point is about 56%, and we're sitting at 67%. That tells you exactly the same thing I told you on Friday. Earnings season so far is better than expected, but it's not like off the charts, holy cow, look at the growth in this economy. Overall growth is about 1%. So it's better than expected. It's just not amazing. It's just sort of like a slower growth, which I think is great for people to get sort of comfortable with that mindset there. But anyways, that's where we're at here so far. This week, like I said, you got a ton of earnings coming out. I'm going to go over them, of course, as we go. Tomorrow, you've got Visa, probably the most exciting out of the group tomorrow. Visa beats on earnings 95, almost 96% of the time. That is the second best beat rate of the week, by the way. So that one will get a lot of attention. And it's pretty volatile, too. It has an average range of about 3.3% on the day that it reports earnings. So this is going to be Wednesday by the time we actually see it. Going into Wednesday, after hours, you got Facebook. That is going to be your most accurate stock of the week in terms of beating on earnings. They beat 96.4% of the time. The range on that one, I hope you like volatility, is 7%. So what all that really means is, if we go over to the charts here and we pull up Facebook, you can go back and just look at prior earnings, these gaps that happen on earnings. Any of these gaps that happen, right? You could see them on the charts. This is not a stock that usually has an earnings announcement and then just sort of floats around like it's no big deal. This thing either takes off or sinks rather hard. And so that'll be, of course, on Wednesday. And then we go down to Friday. You got Twitter. Twitter beats on earnings. Okay, I'm going to say it anyways. Twitter beats on earnings 95.5% of the time. Average range on that one is 12.5%, right? So if you don't like investing in highly active stocks around earnings, Twitter is definitely one you scratch off your list. If you're an active trader and you like playing that volatility, that's going to be a lot of volatility for you. Amazon is also highly volatile, 9% range on that one. They report on Thursday. And where's Tesla? I know Tesla's a big one. Tesla, 8% average range on that one. They only beat 60% of the time. You know, they've had some struggles there, so you can kind of understand that. So if you like all that action, those are some of the names that are coming up this week. I'm going to report a whole bunch more to you here in a minute. If you like low volatility, right, and you're like, I just, where do I go, Dustin? What do I do when it's earnings season and I'm just scared to death of some of these stocks wiggling around too much? Waste Management this week will be the least volatile stock on record. Waste Management, you know, the trash company, you know what they do. We've talked about them last week as well. The average move on this one is 0.01% over its life cycle here. So very much, it's not a big mover, right? This would be an outlier back here. This gap higher usually doesn't do things like that. So the least volatile, while still giving a positive return, is Waste Management. If you go, I don't know, I don't like that stock, what else you got? McDonald's, 0.03%. This one does not usually gap very much either, so you don't have to worry about a lot of volatility on earnings day. They report this week. They actually all report on Friday in the morning. And then Colgate Palmolive, CL is the symbol. Average gap on that one, 0.06%. Like I said, all of these report on Friday. We'll be covering earnings. Probably that'll be our main focus all week because, well, that's what's going on this week. Anyways, last week you had this confusion over the Fed, right? They came out and, a couple people said some things that made us think, oh, maybe they're going to cut 50 basis points. Then the Fed actually emailed the media in a mass email saying, hey, dial this back. We are not looking at this. Every comment made so far was based on prior data, was not indicative of what we plan to do. Anyways, after all that was said and done, you've got a 77.5% chance that they're going to cut rates by 25 basis points at least on the July 31st rate announcement. Now, because it's so close, we will no longer hear from the Fed. There will be no comments, there will be no meetings, there will be no speeches. This is sort of like when a stock reports earnings, you don't hear from the CEO, he disappears. He's not allowed to talk about it, right? So he doesn't go on TV and make a big deal out of things. They can talk about other stuff, but they just don't make a big deal out of that. Well, that's what's happening with the Fed. It's called a blackout, right? So it's currently in their little blackout period there. You still got Trump out there. He can talk. So Trump's out there tweeting the Fed needs to cut rates, and he's making an argument that it seems like the Fed is sort of starting to make. So it seems like they're on the same page, sort of, right? We'll find out on the 31st. Anyways, JP Morgan had a note they sent out to their clients today that said, look, if they don't cut rates by a quarter point, it's going to be pretty nasty for the stock market, and they referred to the depth of the market. Depth of the market is really simply just, if you look at like the E-mini S&P futures and you look at the average bid and ask contracts, the number of buyers versus sellers to oversimplify it, really, really light. Now, some people could say that's because of the summertime. Not a lot of people are trading. All my active traders are busy. They're going on vacation. All long-term investors are sitting back, right? They're just holding on tight. Anyways, JP Morgan's note said the market is really ripe for a nasty downturn because of that low volume, or we call it shallower depth of market. And so we'll see. I mean, it all sort of signs point to that they're going to cut rates. If they don't cut rates, JP Morgan's essentially very, very bearish on the immediate action following that. They would have some room to be accurate too. We've kind of pointed out the stats there to show you how the markets respond after the Fed cuts rates after just raising rates. So that's that one. All right, let's go back to the charts here. Last week, you got the every index moved out of overbought territory from most major technical analysis sort of ways of looking at things. And the Dow was your biggest loser or pulled back the least, right? So hovering here at the highs, that was your better performer of the week. Your micro caps, I'll use IWC, right? Micro caps were yeah, there you go. They fell the most out of the week last week, and they sort of blend into small caps. A lot of people just look at small caps in general. The Russell 2000 up here in the dojo, you can kind of see it's just floating around. It's like, come on, man. It's just moving sideways. That's holding back all of your portfolios, your IRAs, your 401ks, whatever you may have. If you have small caps in there and maybe even a little hint of mid-cap exposure, that's going to be holding you back here in the short term just because of this chop here sideways. Anyways. Sector-wise, we kind of covered this on Friday. I like to do this again on Monday for those of you that took an early weekend there. The communication services, that was your biggest mover and your biggest loser from high to low. That was mostly due to Netflix, and then Facebook pulled back there just a little bit as well. There were only two sectors that showed a gain last week. I don't think we covered this one here. You got your basic materials, and then you have so I'll use XLB for that one. And then you have your consumer staple stocks, XLP I like to use for that one. They gained 0.07% and 0.18% respectively. Bottom line is not a very big gain. Everything else pulled back for the week. Those two squeaked out a tiny, tiny little gain. And so, that's where you're at. Now, in the short term here for this week, you got tech, whether you want to look at XLK or you want to look through and add the semiconductors in there as well. These are still overbought here in the short term, and I don't mean to try to highlight short-term movements. The only reason I point these things out is because if you see that there's a little pull on the market, let's say earnings this week are not very exciting and everything just sort of flatlines, there's nothing really to get you excited or scared, well, then you still have a little pull on the market due to the extension here in your tech stocks or semiconductors and your financials, right? Now, semiconductors were strong today. If I could put the chart back up, you could see SMH moving back into these highs. A lot of that's going to have to do with both Taiwan semiconductors. They reported earnings, and it makes up about 12.5% of the SMH. So it's the biggest participant by weight there. And so that one's a little extended in the short term. If that starts to pull back, you got 12.5% of the SMH that's going to feel a little bit of pressure. Add to that, Goldman Sachs came out today and they upgraded Micron. So Micron was higher, now a little extended here in the short term. A 3.6% gain on that one. That's a nice one today. You had Lam Research. This is also in the same space, 4% gain. That one's also starting to look a little extended in the short term. And Applied Materials also got a boost off of some Goldman Sachs upgrades there. So just a little bit overdone. And all I'm saying is if these take a little bit of a break, you'd expect the markets to take a little bit of a break as well. One area of the markets that didn't look good today was retail. I use the XRT to point this out to you because the XRT, it's a equally weighted ETF, but sort of modified. It's not exactly equally weighted if you want to geek out on this a little bit. But the bottom line is you look at the XRT when you want to know how retail in general is doing. You can look at other ETFs which are sort of weighted to more of the Walmarts and Amazons of the world, or they're market cap weighted, and that's why they're weighted. But the XRT is a very broad way to look at the retail stocks as a whole and see what's going on. If you look at the bottom of the performance list in the S&P 500, you got a lot of names that were near the bottom of the list that are in retail. You got Nordstrom in there, really just a ton of them. I don't need to go through all of them for you. Nordstrom, you got Kroger breaking a new lows there as well. And so retail stands out as one of the weaker areas of the market today. And then we'll point out home builders because tomorrow you have existing home sales. Is that tomorrow? Should be tomorrow. Tomorrow, 10 o'clock, existing home sales. That tends to have a little effect on the home builders as well prior to the new home sales numbers. And so that pulled back just a little bit there. It's flirting with the idea of breaking through this uptrend here. A little bit of pressure today, a little extra volume and relative weakness, right? The markets were higher. This sector sort of pulled back a little bit. That bugs you just a little bit. There's just a few little things. It's like a little crack in the armor of the markets, just little tiny warning signs that don't necessarily mean crash or anything crazy is going to happen, but it makes you sort of go, there's a fly in here apparently. And so it's just these little things that stick out to me there. In the S&P 500, you got 73% of them over the 50-day moving average. That's towards the low end of the recent range, so a little bit of deterioration there as well. Of the stocks that are over the 50-day moving average, still 50% of them are within 5% of hitting new highs. So if I go back to the charts here real quick, it very much is sort of similar to what the index is doing. So even though we're still above the 50-day moving average, which is my blue line here on the charts, we're still very much away from it, right? So we're closer to highs than we are to breaking through the 50-day moving average, at least for half of the stocks in the S&P 500. Tech, as you might guess, is going to be in the lead with the most number of stocks above the 50-day moving average. And we just pointed out the sort of overbought, a little bit of extended move there in that one. And then, energy and retail are at the bottom end of the range here still. Energy, a little pop today on the oil move. And I'm sorry, REITs, not retail. You can use any ETF for that to check that out. These have the most amount of stocks under their 50-day moving average, and a lot of that happening last week. So there you go on that. All right, new highs, new lows. You only had 8 new highs today, by the way. AMAT, we already pointed out one of them there. Your semiconductor had a good day on the Goldman Sachs update. CLAC was the other one. KLAC 10 Core is the name of the stock, I believe. Oh, they just call it KLA Core now. Okay. Anyways, a little extended here in the short term, and you got the stock breaking a new highs there as well. Zodis, if you happen to follow that one, it's a healthcare stock. There you go. A little bit of a breakout there in the short term. And, just one I like to point out. I don't know if you like these sort of things, little technical patterns there. So looking good there. They got earnings on August 8th, by the way. They have a stellar record for earnings if you like following these things. They beat on earnings 84% of the time, and they beat on revenue 88% of the time. It is positive the next day on average, 64% of the time, with a gap of about 1%. On the downside, you got 2 REITs, the same names from last week, Simon Property Group and Macerich, whatever. Simon Property Group, there you go, breaking down again, new 52-week lows on that one. And MAC, these are the relative weak stocks in a sector that's all of a sudden shown a little bit of weakness, right? Remember we just pulled up the REITs, got a bit of a punch in the face there over last week. ICF, you can use either one, whatever you like to use there. Got a bit of a punch in the face there on Friday after already pulling back, so a little bit weak there. You sort of don't like to see that if you're following along. And let's point out Netflix. That'll be your stats of the day. I saw this on Bloomberg. I believe it was Bloomberg. The stock's down another 1% today. This makes 8 down days in a row. There are only 5 other times in history that that's happened, according to whoever's study that was. Maybe Bloomberg's or Ken Show. Maybe it was CNBC. Anyways, so 5 other times that this has happened. The average gain 1 week later, just 1 week later, the average gain is about 12%. What does that tell you? That tells you that investors like dips on Netflix. Now, granted, it's not as volatile as it used to be, but still, average gain 1 week later, 12% over a 5-day period. It was only negative 1 time after being down 8 days. And in fact, it was down 11 days after that, according to these notes here. 1 month later, the average gain is 16%. That number's skewed a little bit because it used to be a lot more volatile than it is now. So just generally speaking, hey, after an 8-day decline, it's generally average a positive gain 1 month later. And 3 months later, it is positive, meaning 3 months later, after being down 8 days in a row, 3 months later, it is always higher than where it currently is now. That's pretty cool, huh? This is something I'd like to track and see how that pans out. Okay, I mentioned existing home sales coming up tomorrow. Equifax agreed to pay $700 million in penalties to settle their overall data breach. Good luck getting money out of them. But supposedly you were able to participate if that happened to you. FedEx, there was Barron's. Every weekend, Barron's puts out all their stuff, and everybody sort of focuses on what Barron's says over the weekend. They were positive on FedEx. They said despite all the issues and stuff going on with Amazon, they like the stock here, very positive on the stock, actually. And from a valuation standpoint, they were very excited about that one. That's their comments, not mine. GNC was lower. They missed on revenues. Halliburton, that was one of your oil stocks, had a really great day today, and actually Schlumberger did well also if you're following along. Almost a 10% gain to get it back to recent highs here. I know it's a beaten down area. Beat on earnings, revenues were okay, and they announced they're cutting costs. They're going to start scaling back just a little bit. Investors always love to hear that. You love to hear that a company you're in, just think about it. You're investing in a company, they're going to cut costs. Maybe that means more overall profit, and maybe it means more money in your pocket, right? So investors love to hear that. Target, it was a little bit lower today. It's been hinting at this breakout. Barron's, their article said they're excited about their strong operating margins, and they see a 15% upside gain from here. So if you like that, it fell about 1% today. That means you got about a 16% potential gain if Barron's is correct. I have no idea of knowing if they're going to be correct, but they were very positive about that one. I should actually start tracking their stats as well. How successful are they? That'd be kind of fun. Anyways, tomorrow you got earnings from, in the morning, Biogen, Coca-Cola, Lockheed Martin, Philip Morris, Sherwin-Williams, that's Black & Decker, also SWK. Travelers Insurance, UBS Bank, United Technologies, so that'd be interesting. And then after hours, you have earnings from Chipotle, yeah, Discovery Financial, Texas Instruments, and Visa. Yeah, I said Visa already. That'll be your best chances of a best performer out of the group there. Ex-dividend date, you got Lowe's paying out 55 cents. So you like to see that as well. If you have any questions, I'll take a shot and try to answer your questions for you. Be specific, though. Help me out, and we'll see what I can do. You making some guesses on the Fed there? Yeah, that's cool. All these analysts are not helping the market. That's an interesting comment. I don't know. I mean, they're doing their job. You know, you can actually track how successful each one of them are. So if there's one in particular you like, you can follow them and see how their picks are. It should be in most platforms that you have there. Yep. Trump can't have the market tumbling. He brags about it too much. Yeah, he doesn't like when the markets fall. Yep. That's a good one. That's clear. Yeah, Huawei back in the news and everything. I get that. Good timing there on the Goldman upgrade. Maybe it was part of that. That's good. Yeah. Kramer says China promised at G20 to buy U.S. farm goods, and they haven't. I haven't followed up on that. Couldn't tell you if they have or not. Yep. Any comments on Philip Morris? Wasn't one of them reporting? They already reported earnings there. So overshoot on the upside. Very common. There was a stock the other day we pointed out, had a great move up and had just been since pulling back. As of now, that pullback on Philip Morris, totally cool, right? You don't like a stock to go too far too fast if you own it. You want it to go nice and far, but you want it to do it really, really slow. Like Waste Management. Never has it gotten too far too fast. That trend will come to an end eventually, but it's not going to happen all in one day. So Philip Morris, just a little bit of an overshoot there, in my opinion. Yep. Haynes Celestial, you're thinking about going long on that one there. I would just sort of question, why? And I'm no disrespect or anything. I just mean, if you're going to commit money to a stock, don't you already want to see that it has fallen and is discounted if you're a bottom picker, or see that it's in an uptrend and there's some sort of momentum there, meaning you want to see that other people are participating with you before you dive in? This sort of feels like money that you'd be putting money to work that really wouldn't work, right? It would just move sideways. Anybody that's bought that stock just kind of watched it just move sideways, and that's frustrating if you're trying to invest in something. Earnings aren't till August 27th. Yeah, August 27th, so you got a while on that one. What's the kicker? What's the catalyst that gets people to come and buy this stock? Maybe there's a news event coming up, nothing that I know of, but question that one, right? You got a stock that just can't get above the 200-day moving average, and if you want to buy it, you're sort of asking to buy a stock that's sleeping at the moment and looking a little bit weak. Yep. Why is Disney not moving? you trying to get it to go? I mean, it's in a nice little uptrend there. So look, you got a nice uptrend. Stocks have moved nicely higher, or this stock has moved nicely higher, taken a little bit of a break here. with all those little things that I've been pointing out about the market, little cracks in the market, just a little bit of warning signs, you can kind of understand why there's just no real excitement there. There's a lot going on in this category right now from a media perspective, but so you do have the possibility of news, but at the moment, just nice and calm. Cool little uptrend. Yep. Sorry if I missed some of your quote. What OTC fund in particular? I don't look at those. Are dividend funds a good hedge against market downturns? It depends. There are many different types of these. There are low volatility dividend funds that would be sort of suitable for that. In general, no. I mean, it's just the comfort of knowing that you have a dividend coming, even if you do lose a little bit. It's not necessarily a hedge. You may look at these different funds and just check them out and say, okay, well, what's their speed relative to the market? What kind of volatility am I looking at? Am I looking at something that's 1-for-1 with the stock market? It's probably going to be a little less than that. I don't know that I would use that as a hedge if I felt sort of negative about the markets in the short term. Who would take over Jazz with ETF stocks if you were to get sick or something to happen? If something were to happen, if something happens to me, basically. So each fund has its own objective, and it's not something that I get to just make decisions on and, yeah, I'm going to buy this stock or whatever. Each fund has a very laid out objective. It's all also on a website, a summary of it. And so the fund can continue to be adjusted based on all the alerts and everything that we have going on here. Also, in our contingency plan, we have another advisor, and we're going to add this other guy soon, that is very familiar with Folio, our brokerage firm, and great guy, actually. So that is technically our contingency plan, where he would reach out and let everybody know. It's by law, you have to have that. So any advisor you're looking at using or anything, look to see who's going to take over if something happens for them. And so it's the same thing, even if you have like a Merrill Lynch advisor or something. Well, what happens if something happens to him? Who's going to manage your account? There's a contingency plan in place. Usually it's another advisor there somewhere that can just take over the accounts. Any advice for new investors on how to play political season? Should have some money in hand for big drops, debates haven't seen. It's a little more volatile, yeah, and it depends on the topic. So I mentioned this a few times, like what is going to be the hot button issue that the Democrats focus on, or what's like their 3-topic platform? Is it going to be healthcare for all? Whatever they come up with, free college or whatever they're working on. When they start hitting on that, that's when you really start to see these different sectors act up. You saw that as a good example with healthcare when Bernie Sanders sort of took the lead there initially, and then it faded away. So they're all hunting for what's going to be their platform. And as soon as they find those hot button things that get you guys to go riot and throw stuff at teachers and all that stuff, then that's what they'll stick with. And so that's how we'll kind of get to know what's going to happen there. As far as a newbie trying to play political season, I don't know if I would set out to play political season and try to profit from it. I would just be sort of on alert what areas are going to be more volatile. That's a tough one. It's hard enough to be new and investing in the markets in general. So to try to play political season, I can say I wouldn't focus on that as my main objective. Technical question, do all gaps get filled for sure or just about? Well, you can't say all of them because there's always a gap that's in the process of being filled, right? There's a stock that gapped higher. Look at semiconductors. Those stocks gapped higher today, and it hasn't had any time yet to fill. The general consensus is every stock fills its gap. It's just a matter of time when it does it. There's no stat that I could say, well, it's, on average, it's 12 months later or 13 days later or something. I would think if that were studied, we would study it on an individual stock basis because every stock has its own sort of personality there. Yeah, there you go. You guys are helping each other out. I love it. Whoa. Okay, try to keep up here. I'm going to go back to the bottom and then I'll scroll up if there's no more questions. Do you typically sit out earnings? Nope, don't sit out earnings. If you're an active trader, you may choose to avoid a stock until they report the earnings. But if you're an investor, no, I wouldn't sit out that. Because all that means, if you're thinking about sitting out earnings season or pulling out to go to cash for earnings season, it means that you're betting too large on one stock, right? It means you built a portfolio that has too large of a position in one particular name that you're worried, right? And in reality, we should be a little bit more diverse. With, no commissions and stuff these days, you can afford to be really diverse, fractional shares and everything. So it should never be where you're like, I'm going to sit out Netflix's earnings because I've got 35% of my entire account in that stock. So for that reason, you wouldn't need to sit out earnings. Thank you, Kyle. I appreciate it. Love doing the show. I really want to, I'm one of those guys that just want to always improve on it, but yeah, I'll have to get some more help here eventually. Are stocks below $10 susceptible to short attacks? I'm going to assume you don't mean short covering. I'm going to assume you mean short attacks. Are they more susceptible? So it's going to depend on volume. It's going to depend on float and everything. You can research that. You can actually look and see how many or what percentage is short. So for example, I pointed out Nordstrom is the most shorted stock in the S&P 500. So one could argue right now Nordstrom is under attack by the short sellers. That'll change eventually, but that's a very broad question. I tried to make it more specific for you. I hope that helps. What's your bond/stock asset allocation for a 50-year-old that's playing catch-up? That is so unique that you asked that question. Tomorrow's video is actually about a plan for exactly a 50-year-old. I don't know how you knew that. Someone's spying on me. But tomorrow at 1 o'clock. And for me, like today's video where we were talking about Steve, for me, it depends on the person. Today's video at 1 o'clock, if you want to go to our YouTube channel and check it out, that's a real indication of how you should invest based on what you want or what you need, what you want, what you can handle. And there's a guy that just couldn't handle a really large move. So I'm not one that says, generally speaking, you should be 80-20, 60-40. I want to work with you. I want to know what you need. How can you handle the volatility? And then we sort of build from there. I have retirees, like seriously in retirement people, not just now starting to retire, who are swinging for the fences because they can. They can handle it. It's not all their money. They're okay with that. And then I have retirees that are really focused on just very small. I want very low, slow growth. I don't want any volatility. I need all this money. And so it's hard to give a general answer to that. Yep. What causes a stock that has moved up during the day to suddenly drop most of its move for no reason? It depends on where it came from, right? So if you have a stock, do we have a good one we could point out? Maybe Disney, I guess. Here's a good one. Here's a stock that gapped higher, had a really great strong start to the day, but it sold off and closed negative for the day. What could have caused that? Well, it's already very extended. There's a lot of people that want to take their profit because they've enjoyed a nice gain from this point. So you really want to ask, like, where's the stock coming from? And if it's sort of in a sideways range and then it blasts off, maybe Halliburton. This is not the greatest example, but what happened with Halliburton today, the stock's sort of floating near lows and then bam, out of nowhere, it gets a 10% move. Okay, now you wouldn't expect something like that to come falling down, right? Whereas that Disney example, you got a stock that's already very, very extended, everything's looking really good, and then it starts to fall just purely due to profit taking. So again, it's sort of a general question. I tried to give you some specifics there, but it really depends on where the stock is coming from. A lot of people miss that. Yep. You saw SKT today. Looked like it did a double bottom in the wiggling room. Well, REITs in general, yeah, a little bit of a struggle there. So you've got money like a little bit of a sector rotation, money moving out of there. This is a great one, going back to the video I did on how to buy a downtrend. You've got the first little sort of possibility of buying that downtrend in there. But that's a tough one. And I think it's tough to buy the relatively weak stocks in what was a strong sector and now is starting to show some signs of a crack. So that would worry me just a little bit, but can't blame you for trying to buy a downtrend. All right, last couple questions. As a 58-year-old newbie, you're playing catch-up, but you don't have large sums to invest. How often should I invest? And again, weekly, monthly. You should do weekly. Do the smaller amount weekly. Whatever you need to invest, do it weekly. There's a tiny advantage there. And at 58, if you're just getting started, take every advantage you can. Every single advantage for that. So that'd be my main advice there. And then from that point, you know how many dollars you need to put in. Know exactly how you need to invest to hit that goal. Don't just randomly pick some fund or don't just do whatever. Know exactly how you need to invest to hit whatever goal you have. You can figure it out. People can figure it out for you if you get help with any brokerage that you're working at or any advisor you're working with. But that's important. We don't have a lot of time to waste there. So you want to make sure you get exactly what you need. Yep. Any thoughts on Shopify for the long term? I mean, I get it. It's done well. It's sort of good and off to a good start there. It's hard to want to buy like what's essentially a triple, right? Since the IPO, it's hard to want to buy. I get it. It could go to $1,000 or something. But for me, I have a hard time looking at that going, yeah, I'll jump on now. So for me, I would hope that it pulled back. Maybe the markets pulled back. Everybody turned their attention away from stocks for the moment. And they were like, oh no, is this going to be the recession? And you get that opportunity. That's what I would look for. Long-term watch list. So if you I keep watch lists for everything, but if you have like a long-term watch list where you say, I don't need to check these every day, I'm just going to check them once a week or once a month, long-term watch list. You got it. There you go. All right. Well, we have officially covered it all. I appreciate you guys all watching today. Get ready. It's going to be a busy week, so make sure you get your sleep on there. Double check your stocks if you're investing more actively. You do probably have them reporting earnings here this week. If not, it's going to be next week. These are 2 very busy weeks for earnings in general, so we'll cover that for you there. And I appreciate everybody watching. We'll see you guys again tomorrow. Enjoy.
Hey, wait! Before you go watch one of our other great videos, have you had a chance to see our new Fin Tips videos? They focus on one topic at a time, covering investing, personal finance, and anything that can quickly help you with your dough. Best of all, we'll keep it real short, because we know time is money.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interests comes before ours.